Your cloud stock dividend could drop $2,000 to $3,750 a year within 18 months. Here's why. If you're in your 50s holding cloud infrastructure stocks because they are growth with a purpose, counting on dividends and buybacks to bridge the gap until Social Security kicks in, the guidance buried in Snowflake's last thank you is telling you something the headline number won't. Revenue beat. Stock moved. Portfolio looks safe, but your income stream is quietly being rerouted into R&D, and that hits your wallet inside 24 months. By the end of this video, you'll know the exact margin compression math from Snowflake's thank you, which 3 peers face the same trap, how to stress test your holdings before guidance season hits in Q1, and the one number in the earnings call that predicts if your dividend gets cut within 18 months. Let's nail the numbers because this is where most investors miss the warning. A $500,000 portfolio with 10% allocated to cloud infrastructure stocks yields roughly 1.5% annually. That's $7,500 in gross income. Now add buyback yield, typically another 1.5% for mature cloud names. You're targeting $10,000 to $12,500 in total capital returns from that $50,000 position. If margin compression forces reinvestment and capital returns drop by 20 to 30%, you lose $2,000 to $3,750 per year. Over a 20-year retirement horizon, that's $40,000 to $75,000 in foregone cash flow. For a household already planning their withdrawal rate in retirement, that's not abstract. That's a gap you have to fill somewhere else, and fast. Here's the wrong belief most dividend-focused investors hold. If a company beats earnings and delivers growth, the income stream is safe. Snowflake's Q3 FY 2024 results looked exactly like that. Revenue beat expectations by 2%. Earnings beat by 15%. Operating margin expanded from 2.9% a year ago to 5.8%. Solid proof of operational leverage, right? But here's where it breaks. Forward guidance doesn't promise continued margin expansion. It hints at reinvestment. The company is signaling that to stay competitive in cloud data platforms, it needs to spend more on R&D and infrastructure. That eats margin. And when margin gets squeezed, capital returns, dividends, buybacks get deferred or eliminated entirely. Here's the cause and effect chain most people miss. Snowflake's margins expanded partly because the company deferred growth investment to hit short-term profitability targets. That was tactical, but the forward guidance is now telling you reinvestment comes next, not optional but competitive. Margins will flatten or contract over the next 18 to 24 months. When capital returns slow, dividend yields compress, forcing you to either cut spending, increase withdrawal rates from principal, or extend your working years by 2 to 3 years. All 3 outcomes hurt. Snowflake isn't alone, and this is the part that changes everything. Datadog, CrowdStrike, and MongoDB show the exact same pattern. Margin expansion in Q3 paired with forward-looking language about competitive positioning and platform investment. These companies are all signaling that beating earnings in Q3 doesn't mean Q1 to Q4 guidance will promise margin persistence. In fact, look at Datadog's recent thank you. They explicitly mentioned a strategic shift toward platform consolidation, which translates to, we're going to spend aggressively on R&D before we return capital again. That's a 2 to 3 year squeeze baked into their roadmap. Here's what makes this urgent right now. The Federal Reserve's dot plot and market expectations suggest rates could hold or rise slightly through 2025. That means refinancing costs for companies stay elevated. Cloud providers that have been able to borrow cheaply for years are now weighing debt versus reinvestment. If they choose reinvestment to stay competitive, and they will, buybacks and dividends take a backseat. For you, the income-dependent investor in your 50s or early 60s, that's a 2 to 3 year squeeze right when you need the cash most. The one number that predicts dividend cuts. Look for free cash flow guidance that lags revenue growth by more than 200 basis points. When a company beats earnings but guides FCF growth 2% lower than revenue growth, they are signaling reinvestment at the expense of capital returns. That's your signal to rebalance. The action step: pull the 10Q filing for any cloud stock you own directly or hold via QQQ, VUG, or sector ETFs. Look at three numbers: 1. Operating margin percent, 2. Guidance language about capital allocation in the next 2 quarters, and 3. Any mention of infrastructure or R&D spend increases. If guidance signals reinvestment, assume a 20 to 30% haircut to capital returns over the next 18 to 24 months. Then ask yourself, does that loss of income force me to adjust my retirement timeline or withdrawal rate? If yes, it's time to rebalance into higher-yielding, lower reinvestment risk holdings like utilities or rate. Markets reward the patient and the prepared. If this saved you from a hidden income trap, subscribe. I'm breaking down the exact cloud peer stress test spreadsheet in next week's video, dropping Monday. Ring the bell so you don't miss it. What's your biggest takeaway?